Okay, welcome everybody to our second training session for VITA. This one is going to deal with income and local tax filing requirements. This is Steve O'Neill. I'm here with Jared Miller. Apologies, we had to cancel the Thursday night training this week due to the unexpected November snowstorm. We always expect to have to cancel a couple things in December, January, and February, but it got an early start here. So hopefully that's not an ominous sign for this tax season. But anyways, hopefully you were able to navigate to this training on YouTube fairly easily. Before we jump in, just want to go over the handouts that do accompany this training. In the email that you received, which had the link to this video, there were some handouts. The first is going to be the PowerPoint slides where you can follow along here. The title of that attachment is 18 VITA Training Number 2. And in the PowerPoint slides, you're also going to find the Dear Iris scenarios that we reference a little bit later on. And an answer key for those will also be emailed out. Second handout that's attached to the email are the 4012 pages. Those are labeled as Training 2 full handouts. So as we go here and Jared goes through his training, he will reference different 4012 pages. And so you can use that handout to kind of follow along and check out what's in those pages. As a reminder, you do not have the official 4012 yet, which is why we're kind of piecemealing this together and providing the relevant 4012 pages for each training. In that same packet, the last page is going to be a guide on how to complete a local tax return. And then the last attachment is going to be the 1040 forms, which is labeled as 1040 in all schedules. So at one point in this training, we will kind of reference the 1040 and talk through that form and the changes that are on that form. This is a shot of the 4012 page handout. This is the first page in that handout. And then this is the first page in the 1040 handout. So hopefully you have those three handouts with you. And last thing before we, all of these handouts will be available at the next training. And speaking of the next training will be after Thanksgiving. We have no training the week of Thanksgiving. So the next training is November 27th at 9 a.m. That's the Tuesday morning session. Or the Thursday evening session is November 29th at 5:30 p.m. Both of those will be at Highland. And hopefully we won't deal with any snow that week. So with that, I'm going to turn it over to Jared Miller, who's going to start and take us through our income and local training.
Wonderful. Thank you very much, Steve. Glad to have everyone here on the online training component. This week's going to be a little bit different than what we had done in the first session, talking about areas of filing status and dependency exemption. Those we're going through some processes of trying to make some determination by utilizing our information we have in the 4012, some IRS guidance, and determining the appropriate filing status. What this session is going to be covering is how we're going to be taking the taxable income provided by our clients and entering that into TaxSlayer, determining what elements are going to be taxable, which ones are not going to be subject to tax. So this one we're going to be going through and talking about the most common forms of income that you'll be facing during the VITA filing season. One of the first things that we always talk about is what is subject to income tax. And what you'll find on your 4012 D1, there are a number of examples coming out of Table A, which will talk about your taxable income in a relatively common set of areas. Now, just bear in mind, this is not an all-exhaustive list of things that are taxable for IRS purposes. If we go back to the Internal Revenue Code, basically what the Internal Revenue Code will state is that all income, irrespective of whether it's paid in cash or property or some increase in economic benefit, is considered income. and would be subject to tax unless there's an exemption for it. Now, fortunately for VITA, we don't have to worry about every single item. We can refer to our chart and determine whether or not it's within scope for VITA purposes. The majority that we're going to be taking a look at, we'll be spending a little bit more time today talking about things like wages, interest, dividends, retirement distributions, Social Security benefits, and a few other items of income. But just wanted to kind of show you here on our first slide a few areas that may be somewhat of an item you may run into during the filing season. Again, some of the big ones we're going to see are going to be our wages. That would include anything of salaries, bonuses, commissions. One area that we have heard a lot of discussion about has revolved around the concept of alimony. And alimony is a payment from a former spouse to a recipient in connection with a divorce. The rules for alimony are changing. However, they're only going to be effective for divorces that are completed after December 31st, 2018. So if an individual is receiving alimony for all of 2018, or receiving alimony from a divorce agreement that it was entered into before the end of December 31st, 2018, that alimony will be considered taxable income. The change that we have coming with the new tax code update is any divorce entered into effect after January 1st, 2019, or any previous divorce agreement that's substantially modified after January 1st, 2019. The alimony will not be subject to tax, and the alimony payment will not be a deduction for the former spouse. But just for this filing season, anyone who had received alimony in 2018 is still an item of taxable income. For annuities, we'll be talking about that concept in connection with retirement distributions. Business income and debts forgiven are a little bit more of an advanced topic. We actually have some special certifications for those, so those will be upcoming in a future training. We will be talking about dividends. Disability benefits can be taxable if they were paid with employer-funded amounts, or if the employee had chosen to deduct their premiums on a pre-tax basis. Generally, these funds will be coming through on a Form W-2 or other type of indication that these are taxable funds. We'll be talking about gains from the sale of property or securities. Again, that'll be an advanced topic that we'll cover in more detail a little bit later on this season. Also, some things we'll take a look at are gambling winnings. You'll see gambling winnings and jury duty fees. Both have asterisks next to them. These are areas that will be subject to income tax. However, the reporting may be a little bit different for these. In fact, we'll see that they're not showing up on our 1040. In fact, we have to go down to a Schedule 1 and then still enter that information separately. Gambling winnings are subject to tax. If you do have gambling winnings, either from casino winnings, lottery winnings, a massive Powerball winning, that would be subject to federal income tax, and we'll get into the state ramifications in another session. As well, jury duty fees for an individual who has been called for jury duty service. If they have retained the jury duty pay, that would be subject to tax as well. There may be a circumstance where an employer will reimburse the employee, basically pay them their normal wages if they're at jury duty. Typically, what will happen in that scenario, the employee will remit the jury duty pay to the employer. In that case, the wages would be taxable, but not the jury duty pay, because that has been remitted back to an employer. Both these items are going to be showing up in a context that we'll go through in just a second here, that will go through the various schedules of items of income. We'll talk about interest, we'll talk about IRA distributions, military pay. There's a special certification for military. Depending on the area in which you are preparing returns, you may see very little to no military activity. Here in central Pennsylvania, we don't have quite as many military pay issues, but there is a special certification which specifically handles military pay. Pensions will be covered in the same discussion with our IRA distributions and annuities. Punitive damages. If someone's received an award and part of that award is for punitive measures, the punitive part of an award will always be taxable. If there is a damage award that is related to medical reimbursement or some other type of accounting for injury, that part would not be taxable. However, the punitive part would be. Also, one item that may come into play could be a refund of state taxes. The main area that we'd see here, the only time that we would see a taxable portion of state refunds or local refunds, depending on how the situation may apply, would be if the taxpayer had taken a prior year itemized deduction for those same taxes paid. In this case, if the individual comes in and mentions that they have a state or local refund from last year, we need to take a look at their 2017 income tax return, take a look at the Schedule A, determine if, first of all, they had been able to take itemized deductions over standard deduction, and secondarily, if they've received a benefit for state and local income taxes paid. If they have, generally those state and local refunds would be taxable in the year of receipt, which would be 2018. If they took a standard deduction or did not receive a benefit for taxes paid, then we do not need to include those state refunds in taxable income. A couple other issues that we're going to be talking about, Social Security benefits today. We'll be talking about a couple other areas in our session on advanced topics, which would be rents and taxable scholarships. If an individual has tips or gratuities, hopefully those are indicated on the W-2. If not, we can actually add them into the tax return for them. There are some specific forms that are actually covered in your 4012. Last thing that we're going to take a look at is unemployment compensation. We'll actually go in a little bit deeper detail and show you how that will be entered into the tax return system. So a lot of people assume that this is a fairly comprehensive list, but fortunately there are a lot of items that are not subject to income tax. And quite often you'll get a question coming from a taxpayer as to what to do with certain items. One of the biggest questions we get is areas revolving child support or gifts or inheritance. The nice part is that child support payments are not subject to income tax. Alimony, as we mentioned, would be subject to income tax, but not child support. The other area is typically large that we get questions about are gifts or inheritance. If the individual has received a gift or has received an inheritance, the amounts that they have received are not subject to federal or state income taxes. There may be some consequence to whoever has made the gift or to the estate of the decedent, but there is no federal income tax responsibility for receiving an inheritance. Now we'll talk a little bit further down when we get to our retirement section. If an individual receives a retirement account, an IRA, 401k, pension account, as they take the payments from those plans, that income will be subject to taxation. However, the actual inheritance, the actual gift would not be. As we mentioned a little bit before, any type of damages for physical injury. So that would include any lawsuits in which they were reimbursed for medical expenses or payment for a physical injury. That includes workers' compensation or any other sickness or injury payments. Federal income tax refunds will never be taxable. So where we have an issue with state and local income tax refunds, federal income taxes are never a taxable item of income. There are also some opportunities we'll see that we have some tax-free interest, which we'll talk about in just a second here when we get to our interest component. Supplemental security income is not taxable. Social Security benefits would be, and they have a potential for a range of which those can be subject to taxation, but supplemental security income or SSI would not be. Same as veterans benefits. Any welfare payments and food stamps are not taxable as well. So the basic presumption we come into is if you're being compensated for injury, being reimbursed from a insurance proceed, where if you had damage to a property and you're getting a insurance payment, that is not taxable income. It's only taxable income if there's some measure of benefit. If you're getting wages, interest, some sort of economic gain, that's typically going to be our taxable amount. So you'll find this complete list again in your 4012 on page D1. Table A will be our examples of taxable income, and Table B will be our examples of non-taxable income. All right, so basically, while we're taking a look at the entire universe, we do want to take a look at the ones that will be most commonly used within our VITA program and filing season. And these will actually be, hopefully, very identifiable in the new 1040. What's going to be unique about our training today is we're going to be talking about a lot of concepts here that are going to be pretty much standard from what you've been accustomed to had you been preparing returns in the past. If you have not been preparing returns in the past, enjoy, because this is all going to be new for you. However, the one major change that we have is how the individual 1040 is going to look. For 2018, you're going to notice a lot of substantial differences in the new form. For example, the 1040, page 1, will now only be identification information for the taxpayer, spouse, and any dependents. This will also be the form in which we would sign if we have to go ahead and file the return on a manual basis. Where you actually find all the numerical calculations is now on page 2. And what we're going to talk about is going through each of these lines in the first 5 lines of the 1040. Page 2 is going to contain our wage income. So any amount coming out of a W-2 will be on line 1. Line 2 will include our taxable interest in line 2B. Our tax-exempt interest would be represented in line 2A. Our ordinary dividends would be on line 3B, while any amount that would be qualified will now be showing up on line 3A. Again, what we're going to see that's different is our IRA pensions and annuities are now only one line. That'll be line 4. The total distribution will be reported in line 4A, whereas the taxable amount will be reported in 4B. Social Security benefits, again, the gross portion will be reflected in line 5A, whereas the taxable calculation will be represented in 5B. Typically, what will happen if those are our only items of income, line 6 will simply add all of those items together and be reporting that as total income. However, there may be a couple other items of income that we had talked about that may be reflected on the 1040 Schedule 1. Some of those will be a very specific line item, for example, alimony received or taxable refunds coming from state and local taxes. This is also where we'll see a couple of the advanced topics such as business income, capital gains and losses, rental real estate. But there are a couple things that also fall into our context of a basic certification. That would include our unemployment compensation on line 19. Any of the other income that we've talked about, the gambling winnings, the jury duty pay, would show up on line 21. And basically we'll have a schedule attached for that. So the balance of Schedule 1 will have some adjustments to income. These are going to be very similar to what we've talked about in the past, but we'll get to that when we talk about deductions and credits. So the 1040 itself is going to look quite different from where it had been in the past. And we'll talk about more of the 1040 as we go through the process here, including items of tax calculation and credit. But what we wanted to do today was talk a little bit more about each of these items of income and give you a little bit more of an example of how the new form is going to look and how we would enter this information within to TaxSlayer. So the first item we take a look at is our wage income. This is going to be coming off of W-2. If an individual was employed, they should be receiving a W-2 from their employer. A couple things that we want to take a look at are ensuring that we know which recipient is getting the W-2, whether it's a taxpayer or spouse. So that will be indicated in box A with the employer social security number. Just as a point of caution, there are times when the employee's name reflected on the W-2 may not be the exact legal name that the Social Security Administration has. For purposes of TaxSlayer and VITA, what we will do is simply identify whether it's a taxpayer or spouse by taking a look at the taxpayer identification number, the Social Security number. That will be our main driving force to determine whose W-2 it would be. At this point, we're going to enter the W-2 information as presented. We need to know the employer identification number of the employer. We have to have the employer's name and address. And because these returns will be filed electronically, we need to go ahead and make sure that the information for the employer information is entered correctly, as well as the employee information. So just as a word of caution, there may be times throughout the year where the employee may have moved, the W-2 or the payroll company may have been using a different address for the employee. For purposes of electronic filing, we do need to put the address as shown on the W-2 into TaxSlayer. When using TaxSlayer, the first address that you're going to enter is going to be the taxpayer's current address. So there may be some circumstances where we need to go ahead and in an electronic form, go ahead and put the prior address as is reported on a government-issued form, such as a W-2. So in this case, we want to be sure that for Missing Muffet, we're putting the 123 Current Street, Lancaster, PA, 17601 into the addressed portion so the IRS can match this up for an electronic filing. Some other areas we want to take a look at are now getting into the numerical component of the W-2. While the W-2s are going to contain all the same information, the form of the W-2 can be quite different depending on who's been issuing the W-2. In this case, we have a traditional 2 per page W-2. These are typically going to be issued to you. The taxpayer may bring 4 copies of a relatively larger size W-2. Depending on the payroll provider, they may also have a much smaller form, have all 4 W-2s on one page along with a summary, but all the information should be the same. They just may be in different places on the actual form as issued by the employer. The important things we're going to take a look at are taking a look at box 1. That'll be representing our taxable income, our wages that we have received for the year subject to federal income tax. We'll enter the amount from line 1 directly into TaxSlayer in the appropriate entry line. The federal income tax withheld from box 2 will also be entered. That will carry over onto our tax calculation form. Just bear in mind, if you're preparing returns in Pennsylvania, that you may see a difference between our taxable wages in box 1 and our Social Security wages in box 3. This is due to the fact that Pennsylvania does not allow a deduction for contributions to retirement plans. One of the things that TaxSlayer will do is when you start entering information into the program, it will automatically bring the amounts from box 1 and assume that they're going to be the same amounts for box 3 and 5. If you have a W-2 and those amounts are different, simply continue entering the information into TaxSlayer. You're basically going to go ahead and just type the information over that automatically calculated line and just enter the W-2 as shown. Just a couple other things that you may see as you get into the tax season. There may be information in box 12, which in this case would be on the lower right-hand side of the W-2. If you see those categories, we simply want to enter those into TaxSlayer as well. They'll be preceded by a code. This may be indicating a variety of things, such as any contributions to a retirement plan, contributions to an HSA, or other items as well, such as group term life insurance or other programs. So a couple things that we want to take a look at. Anything in box 12, we want to enter that in. TaxSlayer will take care of entering that information in the appropriate lines within the 1040. Also, if there is a check mark in box 13, we do want to check that off in TaxSlayer. That will help indicate whether the individual may be entitled to additional retirement contributions. There may be some items in box 14, and in this example, what we have here are items that are related to Pennsylvania employment-related taxes. This is an LST, which is a local services tax. We also have a state unemployment insurance. These amounts do not actually have a home to be entered on line 14, but typically this is where they should be represented in a W-2. These amounts represent, again, taxes for employment-related purposes. So these would be deductible taxes if one is itemizing deductions. So the portion that we would actually enter these in would not be in the W-2 section, but we'd want to make note and enter those in for itemized deductions. One other area that we want to take a look at is our state lines. That would be starting on line 15, indicating that we have a state wage. That would typically be Pennsylvania here in the Commonwealth of Pennsylvania. The employer state identification number may be slightly different than what it is for federal purposes. So just simply enter the information as you see it on the return. Again, the state wages may be different from our box 1 wages for federal purposes. Typically, those should be the exact same amount that we'd see in box 5. Pennsylvania effectively ties their wage base to the Medicare calculation. So theoretically, those amounts should be the same. For Pennsylvania purposes, the state income tax will be entered on box 17. Because Pennsylvania is a flat tax jurisdiction, that should be 3.07% of the amount in box 16. Local wages, if the individual has lived in a municipality that imposes local taxes, that amount will be indicated in box 18. And what we'll see is typically our line for box 16 will be the same as box 18. Any type of local income taxes withheld will be indicated in box 19, and a locality code will be indicated in box 20. Again, simply enter the information that you receive on the W-2 exactly as shown in TaxSlayer. If you have any questions about the W-2 or the taxpayer does, be sure we go ahead and address those. But again, because this is a government-issued form, we need to enter the information exactly as presented. The government will get a copy of this document. So if we don't enter the information, the government will eventually come back and ask the taxpayer why they did not report income that the government is aware of. So those are the issues we want to try and avoid. If we see a situation where the taxpayer believes there is an error in reporting on any of these documents, their first step is to go back to their employer and ask to see if we can correct that invalid information. So our first step is going to go back and make any corrections with the employer. If not, there are a couple other items that we have, but at that point, probably address those concerns with your site coordinator. So the W-2 really has not changed in the past. You'll still have the same information. It will still be entered into TaxSlayer in the same environment as we have in the past as well. So that information you'll find in your 4012. It's a very convenient guide for how to enter information for the W-2. Our next area of income will actually be our interest income. This will be reflected on a Form 1099 INT. Again, when you typically receive forms from our taxpayers, what they will typically give us are a variety of things that may show items of importance. Just bear in mind, if the form has a W, a 10, a 0, or a 9 on it, we probably need to enter that into TaxSlayer. Those are going to be the important government forms. In this case, we're going to see a copy of a 1099 INT, and the 1099 is going to reflect as an information form. The INT is going to be indicating it is for interest income. In this case, what we'll see is there is an interest income line on box 1, indicate how much interest income will be entered in on our tax return. Again, you'll see that we have a recipient TIN that'll help indicate whether this is for the taxpayer or spouse. So what we'll do is just trigger whether or not that should be entered for the taxpayer or spouse in the entry line, and simply enter the 1099 INT as shown. There are a couple things that are a little unique about the 1099 INT. Box 2 would indicate if there's an early withdrawal penalty. Typically, this situation would arise if the taxpayer has taken money out of a certificate of deposit or other long-term savings account before its actual due date. Any early withdrawal penalty entered here on the 1099 INT entry form will calculate and carry over to the Form 1040. If anyone has received interest on U.S. savings bond or treasury obligations, those are entered into line 3. That amount will automatically carry over to the federal return. These amounts are not subject to taxation for state purposes. So the states cannot tax any interest earned on U.S. savings bond or treasury obligations. While we don't often see it, you do want to double check box 4. There are occasions where an individual may have federal income tax withheld on their interest. Typically, it's a result of backup withholding, but we do want to double check just to make sure we don't miss any important items off the 1099 INT. The last item on here that typically we may see is going to be a tax-exempt interest in box 8. If we have any tax-exempt interest for the time being, we will enter that into our 1099 INT input section in TaxSlayer, and that amount will carry over to line 2A on our 1040. Now, one question we typically get from our taxpayers as they come in, they will come in and indicate that they have a bank account, but they never received a statement from their bank indicating how much they have in taxable interest. And the reason for this is the 1099 INT is only required to be filed if there is $10 or more of interest income. If we have $10 or more of interest income, the 1099 will be issued. If it is an amount less than $10, a 1099 will not be issued typically from an institution. However, if the taxpayer brings in a statement from their bank, typically their year-end statement, to show how much interest was earned for the year, you're more than welcome to enter that into our program. So if they bring a statement from their credit union or their local bank showing they've earned 67 cents of interest on their bank account, you're more than welcome to enter $1 into our tax calculation. Hopefully it will not throw off our taxes too much, but you may certainly enter that if they so choose. So in connection with our interest income, another form we may see is our 1099 DIV. The DIV is going to be indicating this is a dividend, and what we're going to see here again is taking a look at the recipient TIN, indicating whether it's going to be taxpayer or spouse. And again, what we're going to do is enter the information as reported directly into the TaxSlayer system. What we'll see in this case is we're going to have a line 1A, which is going to be our total ordinary dividends. That's the amount of dividends that was actually received for the entire year. If the taxpayer met special holding requirements, essentially holding the dividend or stock from a certain time frame around the dividend declaration date, that'll be indicated in box 1B, which are qualified dividends. Qualified dividends actually allow taxpayers to pay taxes at a much reduced tax rate. They can be as low as 0%. Fortunately, we don't need to worry about doing the calculations ourselves, simply because we enter the information in the tax layer, then will automatically be calculated. There may be a couple other things that we'll see coming off of these 1099 DIVs, depending if this is a stock held individually. We'll typically see a very basic 1099 DIV, or maybe coming from an investment company, which may show all the accounts that they hold, such as an online brokerage account. We may also see these coming from a more of a outside financial advisor, which may have a slightly more complex and more robust reporting structure. So you may see the 1099 INT, 1099 DIV, and the 1099B all on the same form. Now with the 1099 DIV, you may see items showing up in box 2A, capital gain distributions. There may be some things showing up in line 7, which is foreign taxes paid. If you see the information, simply again enter it as they're reported in the form 1099 DIV, and the information will carry to the appropriate line on the 1040 itself. The next area that we want to take a look at would be the form 1099-R. And again, 1099 is going to indicate as an information reporting form. The code R is going to indicate that this is a distribution from a retirement-based account, whether a pension, annuity, other type of profit-sharing IRA, or simple type of account. What's going to be unique about the 1099-R is that there's going to be a couple different things that are unique about this form. Again, we do want to take a look at entering the payer information, including the payer TIN. Recipient TIN will indicate, again, whether or not this is for the taxpayer or spouse. And then we'll start taking a look at the information as reported. A couple of things that we'll see is box 1 will show a gross distribution. This will be the total amount of cash that was moving from the account. Typically, we'll see an amount in box 2A. TaxSlayer will default that they'll automatically put the amount from box 1 into 2A as a taxable amount. We'll talk about that in just a little bit of how we can go through some calculations. Where we may run into a little bit of a unique circumstance is if you see a box checked in 2B, either a taxable amount not determined, which may indicate line 2A will be blank, or this may be a total distribution, meaning that the taxpayer has completely withdrawn all the money from their account. Those may be some indication of a few other items that may arise. If we take a look at box 4, this is where we're going to see our federal income tax withheld. So it'd be important to make sure that that information is entered. Quite often we have individuals who may not have taxes withheld on interest or dividends or Social Security, but instead they choose to have taxes withheld from their retirement distributions. So we do want to be sure that that is reported. There may also be some items indicated in box 5 or box 9B. These would be used for purposes of doing a simplified method for determining taxable amount. This methodology is considered an advanced topic, which we'll cover in a little bit more detail in our last session of the season, which would be our advanced topics. One thing we do want to spend a little bit of time addressing is going to be box 7. Box 7 is a distribution code. And what we're going to take a look at here are a variety of codes that are basically going to be within scope for VITA. In addition, right next to that, you'll see a checkbox that'll be IRA, SEP, or Simple. So the distribution codes will help indicate the taxability of these types of payments, and including whether or not these are going to be subject to a penalty. What we're going to take a look at, these codes are going to be replicated in D37 of your 4012 with a little bit more detail as to what all of these mean. A couple of things that we're going to take a look at within the coding system are going to be the ones that are within scope. The one that we should hopefully be seeing, the two that I actually enjoy seeing, are the code 7, which means a normal distribution, which is effectively what we'd see as individuals take money from their accounts as they retire and in contemplation with their account. A code G would be a direct rollover of distribution to a qualified plan. This means that the transfer is not taxable. The taxpayer did not receive the funds. They simply went from one provider to another. And what would happen, we'd get a 1099-R, and what we'd see is an amount in box 1. Box 2 would be non-taxable, so we'd see nothing in the taxable amount for 2A. Most likely it'd be a total distribution box. But if we see a code 7 in box, or code G in box 7, it means it's a complete rollover. That amount will not be subject to income taxation. However, we do need to report it for federal purposes. Typically, that may arise as an individual leaves employment and takes a job elsewhere. The employer will give them a couple options of what to do with their retirement account. Option 1 is predominantly leave the account with the employer and allow them to manage the funds. Option 2 may be to take those funds and roll them over to a new account, whether it happens to be with their new employer or perhaps a self-directed IRA or other type of investment account. Option number 3, which may be presented, is the fact that you may actually take those funds from your retirement account early. This is a tough situation to deal with from a tax perspective. That is what's known as an early distribution. If an individual takes money out of their retirement account before they reach retirement age, which in most cases is typically 59 and a half, they will be not only subject to income tax on the withdrawal, but also a 10% mandatory penalty. That's what we see with a code 1 in our box 7. A code 1 is going to be an early distribution with no known exception. Now, there may be some opportunities for us to go ahead and review and see whether an exception may exist, and those are going to be on the form 5329. If you have a situation, and this is your first time dealing with a code 1, you may want to go ahead and just have a quick, brief conversation with your site coordinator. Typically, what I suggest in these circumstances, if you see a 1099 with a code 1 in box 7, is start asking some questions to the recipient. Perhaps ask to say, it appears that you have taken money out of your retirement account. Just wanted to kind of talk to you a little bit about how were those funds used? Were those used to pay down debt? Can you tell me a little bit more about how those monies were used from your perspective? There are certain exceptions that may apply. However, we don't necessarily want to try and encourage people to try and find a way to get out of the penalty. If they had validly gone ahead and used the money for one of those exceptions, we're perfectly within reason to go ahead and take the 5329 exception. Now, bear in mind, this exception only reduces the penalty. It does not eliminate the tax on the money. So hopefully in these situations, the individual had income tax withheld in box 4. One of the worst kind of scenarios we may see is someone coming with a 1099-R, distribution code 1 in box 7, and nothing in the federal income tax withholding. And the problem we have here is that the mandatory reporting would be 20% of withholding on an early withdrawal. So unless the taxpayer tells their administrator to change the withholding, they should normally have 20% withheld of the amount shown as taxable distribution. Now, if they do not do that, it means that they've actually indicated to their third-party administrator that they do not want withholding on the account. And typically what will happen is they will end up owing tax when they actually file their return. So not a good situation. So if you see a code 1 in box 7, there may be some additional items we need to start discussing. As we mentioned within our trainings, there may be some opportunities that they have to end up paying tax, and there may be some alternatives they have of how they can do it. Now, a few other codes that you may see which aren't quite as punitive may be a code 2. This would be an early distribution from a retirement account. Typically, these are in context of a divorce or transfer of funds between spouses. If the third-party administrator knows that there is an exception that applies, you'll see a code 2 in the 1099-R. The system will know not to try and calculate a penalty and simply report the amount as taxable income. Just as another note, if you do have a code 1 in the 1099-R, TaxSlayer will automatically calculate the 10% penalty, but will not prepare the form 5329. If you need to prepare the form or enter an exception, you'll have to go through a few other steps in order to do that. A few other codes that we may see from a normal retirement type of account would be on account of disability, or a code 4, which we would see if a person's inherited an account. That would be basically a distribution from the death of the original holder. Again, these amounts will be subject to income tax, but will not be subject to additional penalty. There are 2 codes that we want to mention that will be within scope for purposes of VITA that relate to a Roth account. Those 2 codes will be a code H, which would be a direct roller of a designated Roth to a new Roth account, or code Q, which is going to be a qualified distribution from a Roth IRA. If you're seeing any other codes in a Form 1099-R, they may be outside of scope of VITA. So we unfortunately cannot prepare these returns. Now, one other thing I wanted to mention on the 1099-R, our example 1099-R will show a code 7D. Now, the code 7 is going to indicate it's a normal distribution. The code D is going to indicate that this is a distribution from a non-retirement annuity. Now, what that means is for federal purposes, the entire taxable amount will be subject to federal income tax. For Pennsylvania purposes, because this is a non-retirement annuity, the entire taxable amount will be taxable for Pennsylvania as interest income. So we do want to just take a look at some of these codes. For the most part, we may not see a lot of codes that have more than one indication in there, but in this case, we'll see a 7 and a D. So we'll have a federal tax consequence and a state tax consequence. Now, most state tax consequences are only going to be coming from a D, or unfortunately, also from a code 1. A code 1 would be an indication that, again, this is going to be an early distribution for state purposes. A early distribution is considered taxable compensation to the employee. So whatever is going to be subject to federal income taxation, the Commonwealth of Pennsylvania will be looking for that amount to be reported on its return. And when we get to our state section, we'll talk about some options we have about cost recovery and a few other items. But just bear in mind, a code 1 distribution will not only result in a federal tax income consequence, a federal penalty consequence, but may also arise in a state and local tax consequence as well. So a couple other things we want to talk about the retirement income. Typically, the amount that we see in box 1 will automatically be carrying over to box 2A. So the taxable amount is going to carry to the Form 1040, page 2, on line 2B, on line 4B. That will be the amount that's going to be shown in box 2A. If there's nothing shown in box 2A, taxpayer will assume whatever's in box 1 should be fully taxable. So what happens if we do get a 1099-R and the taxable amount is not reported in box 2A? This is a time where we need to ask a question to the taxpayer. And the first question we're going to ask is, did the taxpayer make a contribution with only pre-tax dollars? That would be 401k, thrift type plans. If they did, then the distribution is fully taxable. Quite often when you ask a taxpayer, were all of your contributions made with pre-tax dollars, they may not understand exactly what you're asking. That may be a good situation, because typically if an individual has made a contribution to a retirement plan, it's typically going through an employer, if it's going to be a 401k or 403b, and typically all those contributions are made with pre-tax dollars. That's the situation we'd like to see, because it means all distributions are fully taxable. A situation may arise where a taxpayer has started their own individual retirement arrangement, or IRA, and have made contributions that are considered non-deductible. In that case, we have a bit of an issue, because now we have a problem with the account. Part of the distributions are going to be taxable, and part are going to be non-taxable. So if the taxpayer made a contribution with after-tax dollars, or made non-deductible contributions to a retirement account, then the distribution is going to be partly taxable, and this is going to be complex for purposes of VITA. It's going to be outside our scope and should be referred to a professional tax preparer. These situations are very difficult to deal with. We need to get a lot of additional information from the taxpayer about how much their after-tax contributions were in order to determine it appropriately. Now, again, if you ask a question and they're not sure, it probably means that they did not have any after-tax dollar contributions. And we may go ahead and treat the entire amount in box 1 as taxable income in box 2A. The main situation that these arise from is when a taxpayer has transferred funds from one provider to another. Once the funds are transferred from the initial provider of the retirement account, subsequent providers may not know if there were any amounts sitting in that account as after-tax or non-deductible contributions. So that's typically why we'll see an amount that's shown that taxable amount's not determined. But typically what we'll do, unless there's a situation where the simplified method may be employed, that the amount in box 1 will also be the amount in box 2A. If the amount in box 2A is different than box 1 and the administrator has an amount sitting in there, by all means, use the amount in box 2A. There's probably a calculation that they've gone through which may include a non-taxable portion, meaning that it could have come from an annuity or some other type of retirement vehicle where the entire amount of distribution is not taxable. So the situation we're talking about here, if there's nothing in box 2A, then typically TaxSlayer will treat the entire amount in box 1 as taxable. If there's any other issues with that, we can certainly talk to the taxpayer and may need to have some follow-up. Now, the other situation we take a look at for retirement would be for Roth accounts. Now, Roth distributions are a bit unique. They are a vehicle that basically will have retirement funds that will not be subject to income tax as long as the following conditions are met. The first distribution has to be made 5 years after the initial contribution was made. So once that first contribution was made, the 5-year kind of tolling period will start. Then we also need to see whether that distribution is made after age 59 and a half, due to disability, is made to an estate beneficiary, or to pay certain first-time homebuyer amounts. If that has occurred, what we're going to see at that point is we're actually going to have a qualified distribution from a Roth IRA, and that will be a code Q showing up on the 1099-R in box 7. If that happens, then we are more than welcome to go ahead and prepare the return. Typically, that'll be showing that there is zero amount of taxable distribution in box 2A, and that will be fine. However, if the tests are not met, then the distribution can be partly taxable. And again, similar to what we had run into there with the 1099-R, with the 2A amount, if there is a partial taxability for a Roth account, that is outside the scope of VITA, and we cannot prepare the return. So unfortunately, at that point, what we're going to have to do is to politely gather all the documents the taxpayer had given to us and return them to the taxpayer and refer them that they need to go ahead and have those returns prepared by a professional tax preparer. So code J, if you're seeing it on a Roth IRA, would be outside our scope of VITA. Okay, so now for some good news. The 1099 SSA has not changed in the past. What we're going to see here is the 1099 SSA or the SSA 1099 is going to be reporting our Social Security benefits. The nice part is the entries for these are relatively straightforward. There's actually one section in which we would go ahead and put our Social Security amounts. What we need to do is to identify whether the Social Security benefits relate to the taxpayer or the spouse. And again, that should be indicated by the name and beneficial Social Security number in box 2. What we're going to have on the Social Security entry page is you'll actually have a couple different items for entry. First will be the amount of taxable Social Security benefits, which you'll find in box 5. In this case, what we're going to show is that you have $12,288 in your example of taxable Social Security benefits for the current year. That amount would be reflected in our entry for TaxSlayer. The other thing we'd want to take a look at is box 6 would indicate if there is any federal voluntary income tax withheld. If so, we would enter that amount into TaxSlayer, and that amount will automatically carry to the 1040. The last item we take a look at is if the taxpayer had Medicare premiums withheld from their Social Security benefits. Those would be reported in box 3. The Medicare premiums themselves, whether it's Part A, Part B, Part D, would be considered a deductible medical expense for purposes of itemized deduction. So if you're entering information in the SSA 1099 entry screen, you may enter these 3 amounts: the total taxable amount, which would be from box 5, any voluntary federal income tax withheld from box 6, and then any Medicare premiums from box 3. Simply add up those amounts. You may need to add a few of those different parts together to come up with the total, but you can enter them directly into the SSA 1099 entry form, and those will carry to the miscellaneous itemized deduction for medical expenses. So it'll be carried automatically to our Schedule A for itemized deductions. So fortunately, not a whole lot of change in Social Security. What you will see is that from Social Security perspective, not all of the amount in box 5 will be subject to income tax. That's going to be based on a couple different factors, including the taxpayer's filing status, the taxpayer's total income, and modified adjusted gross income. So that amount can range anywhere from 0% up to 85% taxable Social Security. Again, the TaxSlayer system will do the calculation for you. So all we need to do for the income section is find the appropriate entry point, go ahead and enter the information that you've received from the government forms directly into TaxSlayer. Now, the last form that we want to talk about is actually one that will be reflected on the Schedule 1. The first 5 pieces we had talked about were all going to be on page 2 of the 1040. This one is going to be a form as received for unemployment compensation. This is going to be reflected on the 1040 on Schedule 1, and this is going to be on line 19. What we would do is we'd receive a 1099-G, and again, the G is going to refer to a government payment. The 1099 forms hopefully make sense of the indication. So the codes that you see, if you don't know exactly where to enter those, if you type in 1099-G into your search bar on TaxSlayer, it'll automatically take you to the entry section. In this case, we're looking at unemployment compensation, so we need to enter the payor. In this case, it would be the PA Department of Revenue, along with their identification number. The nice part is with these types of systems, as long as someone in the program has already entered the information the first time, the next time you enter the employer identification number, it will automatically populate. So if you're going a little later in the season, hopefully someone's already entered a lot of the detail for you. For a 1099-G for unemployment compensation, we're going to make sure that we have, again, the correct party, whether it's a taxpayer or a spouse, as indicated by their recipient identification number. We'll want to be sure we enter the unemployment compensation from box 1 that will be subject to federal income tax, but not for state and not for local. Quite often, the individual may have had federal income tax withheld on the 1099 unemployment compensation benefits. If so, that'll be reflected in box 4 and simply entered into TaxSlayer, and will carry to the appropriate line on the 1040. So fortunately, with the 1099-G for unemployment compensation, just a few items to take a look at there. Traditionally, it's going to be the total amount of unemployment compensation, and if any amount had been withheld for federal income tax. So that's kind of a quick overview of the federal income tax areas, not only all the areas that could be subject to tax, the amounts that we were looking at for non-taxable, but covering our top 5 lines on the 1040 page 2, plus another government form you may see on occasion in VITA, which would be populating in Schedule 1 and then come over in our calculation. Now, a couple other issues that we're going to take a look at is, in addition to federal tax, we also wanted to cover local taxation. One of the reasons we wanted to do this, because it ties in specifically to our income items. The other issue we take a look at here is that local tax information will not be found within your 4012 or on the IRS website. We do suggest that the best place to look for this information is within your VITA volunteer guide. That's going to be our best source to figure out how to complete the local returns. So the question is who has to file a local return? So for a local return perspective, if you lived in Lancaster County or in part of Octor School District, which is actually in Chester County, for any or all of 2018, and you also had earned income or net profits from an employment or from any transaction as a sole proprietor or an active partner in a partnership. So what we mean by this context is if you received a W-2, if you were a self-employed individual, or if you were an active partner in a partnership, that is considered earned income. And the local tax is only going to be taxing earned income. So again, anything you may have from wages, anything you may have from operating your own business, or being a partner with other partners in a partnership or LLC. This tax only applies for individuals age 16 or older. So you may see a W-2 where the local wages do not match the state, particularly if you're doing that for a dependent of a taxpayer, and that may be entirely fine because they may have only started the local tax withholding once the individual started age 16. The tax does not apply until that individual turns 16. Any wages earned at age 15 or younger are not subject to local tax. A couple of things that we need to take a look at for the local return. We have to make sure that we have the taxpayer's name, their address, phone number, and social security number. Now, what we're looking at doing here is having the opportunity for TaxSlayer to help generate these forms for us. But we still need to enter a couple things into the program. One of the important things to make sure that we get correctly is their PSD code, which would be their local municipality code, which will automatically generate their tax rate. Now, one item that we take a look at, we may ask a taxpayer if they know exactly where they live. Now, they probably understand the address, they probably understand the neighborhood that they're at, they probably can give you general directions of how to get to their home, but they may not know exactly which municipality they live in. They may know the school district, but we need to drill down even deeper into understanding whether in a township, a borough, or which municipality they're in. If they're not sure of where they live, and this may occur predominantly in situations where individuals rent, we can use a municipal lookup code feature. It's a website that's going to be available on site that you can go ahead and determine which appropriate code to use for the local return. Once we do that, we'll complete the rest of the return by looking at the filing status for the client. That can either be a married, it can be single, or it can do a final return. If there's no income, what we want to make sure we do is that we select a reason in the appropriate box, whether that's they're disabled, they're retired, they're unemployed, they're a homemaker, they're deceased, they're a student, whatever the case may be. We want to be sure that we indicate why there's no income and send that back. Particularly in a situation where you may have someone who's retired, I'd suggest you check the retired box and also check the final box for the filing status. That will hopefully take the individuals off the Lancaster County tax rolls. One thing we do want to take a look at is entering the local wages and withholding from the W-2. That amount will show up as gross compensation, and the local tax withheld would show up in box 10. If everything has worked effectively, we'll see a situation where the total amount of wages will actually be very close to what the total tax withheld is. So typically, we don't see a lot of situations with balances due or refunds coming back. But we do want to make you aware of a couple things. If you owe less than $1, you do not need to go ahead and pay that. That is not required to have a check written for $1. You can just go ahead and submit the return if it shows $1 or less. Likewise, if you have a refund of $1, try not to get the client all excited that they're going to get $1 in the mail. It will not be sent out unless it is a $2 or greater refund. Now, a couple things that we do want to mention, very, very important concepts here. If the taxpayer has come in and they are bringing you a pre-printed form from Lancaster County has them on file and will be expecting a local earned income tax return. So even if the clients are retired, if maybe they've changed their jobs, we do need to submit that local income tax form back to them again. This is where we may want to go ahead and check off one of the reasons why they're not having any income. Again, whether they're a homemaker, whether they're disabled, whether they're unemployed or retired, and checking the final box. That will hopefully go ahead and take them off the rolls. If that does not happen, the Lancaster County Tax Collection Authority can go ahead and assess a penalty for failure to file. So even if there is no local tax due, no local earned income, they can get a failure to file notice, which typically would occur in late fall or in the summer time frame when the government knows that they haven't filed a return. So the best bet, if they're bringing in a pre-filled out form with their name and address on it, we definitely need to send that back to Lancaster County, even if they do not have any earned income. They'll need to sign it and send it back in and hopefully have their names withdrawn from the list. This may take some time, so you may have people who keep bringing in a blank form, but we still need to fill that out each time to indicate that there's no local earned income tax and nothing that would be subject to taxation for Lancaster County. Now, again, as we mentioned, your best resource for the local return is going to be in your volunteer guide from VITA. It's going to show you how to go through and prepare the return, and also provides information for how we can complete either blended tax rates if an individual moved to various jurisdictions within Lancaster County, or if we have a situation where an individual has moved to or from Lancaster County and we need to complete an other county local return. So that guide is great to be able to go through and to figure out that information. There may be some circumstances where we may still have to do some manual returns, but there may be some great benefits this year if the program will cooperate. But if you have any questions with those, feel free to at first take a look at your guide and then consult with your site coordinator. But at this time, I'm going to turn it over to Steve to kind of give you some great news about the local returns and some options that we can do on how to complete a local return in your packet.
All right. Thanks, Jared. So the great news about this year is that we do expect to be able to do a local tax return within TaxSlayer, which is really nice because the past couple years we've had to do all local returns by hand. Now they are still kind of finishing up the production version of TaxSlayer, but we do expect the ability to be able to do a local return within the system. That does not mean that it can be electronically filed. However, that would be nice, but although we will be able to do it in TaxSlayer, it will print out for us, which will be really nice, but the client will still need to mail that one in. It's not electronically filed. But with all that said, I think that one of the best ways to learn about how the local form works is to practice doing one by hand. So what we'd like you to do is to prepare a practice local tax return. You're going to find in the email where you found the link to this video, you will find a blank Lancaster County local tax return. It'll kind of have a pink or red hue to it. And then you can take the W-2 from this PowerPoint presentation for Missy Muffet and use that W-2 to prepare a local tax return. A couple of the important things to have on a local tax return is going to be the PSD code, which indicates the municipality that the taxpayer lives in. And you will find that about halfway down next to the space to enter the Social Security number for the taxpayer on the local return. You can use 361002 in this example. That's actually the Lancaster Township municipality code, and a tax rate of 1%, which is the Lancaster Township, and most municipalities are at 1%. So you can use those two things, and you should end up eventually with a refund of $20. One thing that we have in your packet, the packet that had the 4012 pages in it, the very last page of that packet has this form on it, which has some helpful tips to be able to do a local tax return. This actually looks like the form that will print out from TaxSlayer, but the flow and most things match up pretty well with the local form that we attached to the email that you would use to do by hand. So you can use this as a guide to help you do it. Again, you're going to want to use I'll go back to it. You're going to want to use this W-2 from Missy Muffet, and the PSD code here, tax rate here. You can use this form as a guide, and here is the local form that we've attached to the email. As you can see, it has kind of that pink hue. You can print this out and do a practice return for Missy. Couple other items that we have for practice for you are these Dear Iris scenarios. There was some confusion and controversy last week, but we do feel that these are helpful. So I think that there are 5 Dear Iris scenarios that you can work through, and you will find the answer key to these again in the email that we sent out. So hopefully those are some helpful ways to start applying the things that Jared has been presenting on, and start to incorporate the theory into practice for you. With that being said, hope everybody has a happy Thanksgiving next week. Again, we are off for training next week, and we will be back on November 27th. So hope everybody has a happy Thanksgiving. Jared, anything to sign off with?
No, just enjoy your holidays. We'll be looking at, now that we have the income entered into the tax returns, the next couple weeks will be even more exciting as we talk about deductions and credit opportunities, and talk about how we can actually make an impact with the filing process with the individuals utilizing the VITA program. So this is kind of an overview today of where the income is going to come from. Again, what we're taking a look at are really finding the information coming from the taxpayer and choosing the best way to enter that in the tax layer. For the next couple of weeks are going to be very exciting, so stay tuned.
All right, and thank you, Jared, for doing this, and thanks everybody for watching. Happy Thanksgiving.